to move.
Right. But going to 4% for a lot of these banks, I mean, that would just, can they operate that way?
Well, they will lose money.
Yeah.
And this is the key thing. I think we have to start qualifying Fed governors as to whether they can do bond math. Because clearly, if everybody bought all those securities during COVID with those low coupons, and then we moved the base rate 5.5 points, everyone is insolvent, right? This is basic math. So to me, we're going to continue to live with this, and the street is going to pick on smaller banks with weaker funding that maybe are below book already. Once you get below half a book value, you're a target. Very simple. Once your beta goes up to the point where you're twice JP, which is usually below 1, these are pretty boring stories. You don't talk about them very much on Fast Money. But, you know, you're moving too much, and the pendulum starts going back and forth. You saw this with PacWest, and then the counterparties start backing away.
Who is the actual winner, though? Because what we've seen, I mean, J.P. Morgan gained, I think, like $10 since the banking crisis began, which is, you know, clearly. Bank of America, though, on the other hand, sitting at 2-year lows or so. So, you know, who is actually winning out of this? Because it seems that you could have easily moved your deposit to a J.P. Morgan or Bank of America immediately in the aftermath of the collapses, but then just as easily move that out to some fintech firm that was offering 5% on something because JP Morgan's at 0.1%.
Or some of the broker dealers are offering very high rates.
Interactive broker, for instance, is 4 plus.
Exactly. Well, they are competing for funds, and JP Morgan is competing. Now, Bank of America.
Are they competing at 0.1%?
No, but look at where their teaser rate is out on the bulletin boards. They're looking for money because they know that the runoff at the Fed is real. Every time a bond redeems, a deposit disappears. So they know they're going to have to look for funding. But consider the difference between JP, which manages their duration very, very closely, tries to keep it short, almost like a broker-dealer. Bank of America keeps everything. So one of the reasons that stock is not performing well is that people know that there's an embedded duration problem at Bank of America that's going to hurt earnings over time. They own 2s. They own 2.5s that they're not going to sell. And when their funding costs are 4, then they're going to be losing money on those assets. It's like the S&L crisis all over again. It really is.
That's a huge comparison. I mean,
well, when Paul Volcker raised base rates 4, 5, 6 points above deposit rates for S&Ls, the S&Ls disappeared. Right? Basic math. Now, S&Ls were a tiny part of the U.S. financial system. Banks didn't lend on real estate in the early 1980s. Today, real estate exposures, which have a duration aspect, right, that's variable, are throughout the system. Everybody owns this exposure.
Last time I spoke to you, actually on Squawk Box, you were long Western Alliance.
Not anymore. Kicked it out.
Not anymore. You're out.
I can buy it back later. I was accumulating that for the eventual drop in rates because it's a mortgage play. They own AmeriHome. They bought it from Apollo. All of those stocks are still going to be there when rates fall.
Oh, yeah.
And mind you, look at PennyMac, look at Mr. Cooper. They're up year over year, almost 30%. Why? Because people are starting to position for the eventual decline in rates when volumes come back.
So in the meantime, I mean, what is going to be the catalyst, the ballast for this sector to sort of firm up?
For the banks?
For the regional banks.
Stay out of the headlines, as PacWest said. And I think also at some point the Fed has to relent.
Well, if let's say the FDIC comes out and says blanket insurance for all deposits. Is that going to be anything? Is that going to be a catalyst?
If they did that, yes.
Yeah, it would be.
But the real issue is transaction deposits for business. It's not the 250 limit for most depositors. You don't need to deal with that. They're fine. But the problem is the business customer who's got payroll at a small bank who feels antsy and says, uh-oh, I better put this money in a money market fund. And by the way, the yield is double.
So is KRE still a short?
I think all of the small banks are still targets. They're good. Look, imagine if PacWest gets taken over. All right, let's say Western Alliance dodges the bullet. What do we talk about then, Melissa? We start talking about Ally. We start talking about other banks that fund in the market as opposed to off-core deposits. Do you think the Fed will ignore that? Because the asymmetry of their policy is that they think they can do a conventional tightening with Fed funds and ignore the $9 trillion worth of bonds they bought. No, they should have done both. And it's the lack of balance in Fed policy that's the reason we're having this conversation this morning.
Chris, thank you. Good to see you.
My pleasher. Have a great day.
You too.
Thank you. got to think about all that. Thanks. Thank you, Chris. Coming up, I told you. Glad you were doing that. I just watch kind of in awe. Look what's coming.